So there are many different types of trusts out there that are available and they do different things. That's why estate planning is never a one-size-fits-all process. One type of trust that my office often gets questions about is a qualified disability trust. And I'd like to answer some of the questions about these in this video. So in short, a qualified disability trust is designed to help people with disabilities who are under age 65. It's a type of special needs trust that basically comes with added income tax benefits. And who doesn't want to save on income taxes? So let me give you a little bit of a history. In 2001, Congress passed the Patriot Act, and it gave a small tax benefit for some disabled beneficiaries of special needs trusts. This is now found in Section 642B2C of the Internal Revenue Code, in case you were curious. So qualified disability trust is abbreviated as capital Q, capital D, little I, little s, capital T. So maybe QDIST, which is funny because to me that kind of sounds like who-dis, right? But QDIST. And if a trust qualifies as a qualified disability trust, it gets an income tax deduction equal to the personal exemption. Well, in 2018, the Federal Tax Cuts and Jobs Act eliminated personal exemptions, but the qualified disability trust exemption still remains. And in 2024, the exemption amount is $5,000. So for a special needs trust to be a qualified disability trust, it has to meet these criteria. First, the trust must be irrevocable. Next, all beneficiaries of the trust must be disabled and they have to be receiving either SSI or SSDI benefits. So it's not enough if the beneficiary is receiving Medi-Cal due to, their low income, or maybe they have mental health challenges, but they can't work, but SSI still doesn't consider them disabled. They really do have to be qualified as disabled through the Social Security Administration. However, remainder beneficiaries, after the main beneficiary dies, wherever the money goes, they don't have to be disabled. Okay, and then the third qualification is the trust cannot be a grantor trust. So a grantor trust is where the grantor or the creator is also the owner of the trust for income tax purposes. This is typically the way a first-party special needs trust is set up. And finally, the trust must be established for a beneficiary who's age 65 or lower. So why should you care if a special needs trust qualifies as a qualified disability trust? Well, trusts are taxed at compressed income tax brackets. For example, in 2024, a single person only reaches the highest income tax rate of 37% when they reach at least $690,000 of income. But for trusts, they reach the highest tax rate of 37% when they reach only $15,200 of income that year. Isn't that crazy? I think this is because trusts don't have good lobbyists. Oh well. So the $5,000 deduction for qualified disability trusts can really make a difference in what tax bracket that trust falls into with the generated income that year.
Hey everyone, if you like my mom's video, like and subscribe.
So I want to give an example, and I apologize for using math, but hopefully this will make sense. So let's say we have Joey, and he's the beneficiary of a third-party special needs trust. There's $800,000 in the trust, and it's generating $50,000 of income each year. Of that $50,000 of income, $30,000 is used to pay for Joey's expenses, and $3,000 is used to pay the trustee for trustee fees. So that means that the trust taxable income is $17,000, and it would be taxed at the highest tax rate of 37%. But what if Joey's special needs trust is a qualified disability trust? The trust would get a $5,000 exemption, so the trust's taxable income is now $12,000. It's in a lower tax bracket, and it's subject to less income taxes. That's really helpful. So it can be very beneficial to draft your third-party special needs trust for a disabled beneficiary as a qualified disability trust. Now, I do want to mention that I'm not an accountant and I don't prepare income tax returns. So I know just enough about this to be dangerous. If you really want to dive into the nitty-gritty, you should talk to your accountant, especially an accountant who regularly prepares fiduciary income tax returns, which are also called Form 1041s. Most accountants prepare Form 1040s, which are individual tax returns, but you want to talk to somebody who specializes in fiduciary tax returns. I hope this has provided some clarification for a pretty complicated tax subject. I discuss income taxes for special needs trusts more in my video called How is a Special Needs Trust Taxed? And I suggest you watch that video next.
Hello everyone. If you liked my mom's video, don't forget to like and subscribe. See you all next time.